Hi, this is Brandon Bischoff with Canterbury Investment Management. And this is the Canterbury Market Update for the week of January the 20th, 2020. So starting with the market state, we are in a bullish market state 1. And as we mentioned in several other updates, most new market highs do occur in market state 1. About 86% of all new market highs happen while the market is in market state 1. Canterbury Volatility Index currently measures 45, and that is in extreme low territory still. So as we mentioned last week, when volatility is extremely low, you're more likely to see a spike in volatility that will lead to outlier days, either up or down. No telling when those will happen, but extreme low volatility is a bullish market characteristic. And it's much better than extreme high volatility, which is a bearish market characteristic. This week's market commentary, we're going to be talking about the difference between companies and stocks. And to do that, we're going to look at Tesla Motors. So it seems like Tesla's in the news just about every other week. And in fact, to begin 2020, they've had a strong surge in stock price. Just so far in the very few short amount of weeks we've been in 2020, they're up a little bit, just south of 20%. If we actually go back to June of 2010, which was when the company's initial public offering took place, the stock price has risen from $17 at its IPO to Friday's close of $510. So Tesla's stock is up 2,900% for the last decade. And so based on that information, you might believe that Tesla's got to be one of the most innovative companies and one of the most profitable to go up 2,900%. Well, they certainly are innovative. There's no question that Tesla's all-electric lineup shook the automotive industry, caused many of their competitors to start trying to produce electric vehicles. But is Tesla a profitable company? No, it's far from it. In fact, every year since 2011, Tesla has reported negative net earnings every single time. In fact, in the last 4 years alone, the company has lost $4.5 billion. But over that same 4-year time frame, its stock is up 114%. So they've lost $4.5 billion, yet their share price has doubled. And so if we compare that to Ford and General Motors, Ford and GM since 2011 have reported, earnings every single year, positive earnings every year. In fact, last year or 2018, Ford reported $3.7 billion in net earnings. General Motors reported $8 billion in net earnings. So they're very profitable companies. Yet when we compare it to Tesla's stock, well, since 2011, if you would have invested $10,000 in the General Motors, you would have averaged 2.5% per year, and your 10 grand would now be worth $12,500. If you would have invested in Ford, you actually would have lost 2.6% per year, and your $10,000 would have been worth $7,800. Invest in Tesla, your $10,000 would be worth $193,000. Next, if you look at the market capitalization, and what market cap is, it's basically the equity value of a company, and it's measured by the total number of shares outstanding versus the share price. So in Tesla's case, there's 193 million shares outstanding, and the share price is $510. Therefore, Tesla has a market capitalization of $98 billion. $98 billion market cap is larger than both Ford and General Motors combined. So how is it that a company that reports negative net earnings every single year can be worth more than both Ford and General Motors combined? Well, one simple answer is the benefits of compounding. And so basically for your $10,000 in the market cap of Tesla, it kept doubling. And each time it doubles, it goes off a larger base. So in the case of the $10,000 investment back in 2011, it would have taken about 5 years for your $10,000 to grow to $100,000. And in that time, it would have doubled a little bit over 3 times. Well, then in the last 4 years, your $100,000 would have doubled one more time to get to $200,000. So it would have doubled 3.5 times to get to 100, and then one more time increased by $100,000. So that's really the benefit of compounding, and that's how Tesla's market cap goes to grow so much, because it just keeps doubling, and each time it doubles, it comes off a larger base. But this really goes to show that companies and stocks are two very different animals. A company A private company is going to be driven by profits and earnings. So you have to know the difference between a good company and a bad company if you're going to buy a restaurant, for example. Stocks, on the other hand, are driven by supply and demand and investors' beliefs about the future. And so if you want to invest in stocks, markets assume that you know the difference between stocks that are showing bullish characteristics and are under accumulation and stocks that are showing bearish characteristics and are under distribution. And that's why we practice adaptive portfolio management. So a traditional buy and hold approach just doesn't navigate markets. Basically you buy all these stocks and just hold them, and you go through all the swings, both bull markets and the large drawdowns that come with bear markets. Whereas with adaptive, what we're doing is we're identifying the securities that have the right characteristics to increase in value. And those are, low volatility and under accumulation. And if we can do that, we can successfully limit our drawdown to a normal correction, and therefore every time we increase, we're coming off a larger base, and we're achieving the benefits of long-term compounded returns by avoiding the large drawdowns that come with high volatility in bear markets. But that brings us to the end of this week's market update. Thank you, and I hope you have a great week.